Hey, welcome. Have you ever stood in a city, looked up at one of those giant, glittering skyscrapers, and just thought, wow, I wish I could own a tiny piece of that? Well, guess what? Today, we're going to talk about how you actually can. And you definitely don't need a billionaire's bank account to do it. Let's jump right in.
I mean, just picture it for a second. Every single month, thousands of people are shopping at a huge, popular mall. Now, imagine a little slice of the rent from all those big name stores flowing right into your pocket. It sounds like a dream, right? Or get this. What if every time a car zoomed down a busy highway and paid a toll, you got a tiny piece of that action? That's the kind of passive income people talk about. And you know what? It is way more real than you might think. So how on earth is this possible?
Okay, let's unlock the first part of this puzzle. It's something called a REIT, which is short for a real estate investment trust.
Think of a REIT like this. You and a bunch of friends want to buy a giant party-sized pizza, but nobody can afford it alone. So you all chip in. A REIT does the exact same thing, but instead of pizza, it's buying massive income-generating properties. You buy a unit, which is basically your slice of the pie, and you get your share of the profits. Simple as that.
All right, that sounds cool in theory, but let's get down to brass tacks. How does the money actually end up with you? Let's walk through a super simple example.
So, let's say our REIT owns a big, bustling mall. After taking care of all the expenses, it collects a cool 10 crore rupees in rent for the year. And let's say this REIT is divided up into 1 crore units. So, what does each unit get?
Each unit would earn 10 rupees for that year. That payout, they call it a distribution, is just your share of the rent passed directly to you. Now, what's really cool is that this idea doesn't stop with buildings. Let's look at its cousin, which does the same thing, but for the essential stuff that keeps our country up and running. Meet the InvIT, or Infrastructure Investment Trust. It works just like a REIT, pooling money from investors. But instead of buying office buildings, it invests in things like toll roads, power lines, or gas pipelines. So instead of rent, you're getting a piece of the cash generated by, say, thousands of daily toll payments on a highway. That's the money that flows back to you.
So, whether we're talking about a REIT or an InvIT, you might be asking, okay, so what's the actual process? How do I get paid? Well, it's beautifully straightforward.
It's really just 5 simple steps. 1, investors like you and me pool our funds. 2, a team of professional managers uses that money to buy a high-quality asset. 3, revenue is collected, whether it's rent or tolls. 4, the earnings are distributed back to us, the investors. And here's the best part. By law, these trusts have to pay out most of their income to you. And finally, number 5, you can buy and sell your units on the stock exchange, just like a stock.
So just to make it crystal clear, here's the main difference. With a REIT, you're in the real estate game. Your income is from rent. With an InvIT, you're backing infrastructure, and your income comes from cash flows, like tolls. Both are fantastic ways to add something different to your investments.
Now, I'm sure this sounds pretty interesting, but you probably have a few questions popping into your head. So let's tackle some of the big ones right now.
This is a huge one. Anyone who's ever thought about buying a property knows about the headaches, the taxes, the registration fees, all that paperwork. Do you have to worry about any of that here?
The answer is a big, beautiful no. And that's the magic of it. You're a unit holder, not the direct property owner. The professional management team handles all of those operational nightmares. You just get to be an investor and collect your share of the income. Totally hassle-free.
Okay, fair question. This is a real concern. What if something happens to the property? You know, a fire at a warehouse, or maybe a storm damages the power lines. Are you on the hook for those massive repair bills?
Nope, you're covered. The fund manager's job is to make sure the assets are fully insured. That means your personal risk is only what you put in. You are not personally on the hook for any of those damages. It's a huge relief.
This is a really important one to understand. Since you can buy and sell these on the stock market, does that mean the price can move around?
Yes, absolutely. Just like a stock, the price of your units can go up or down based on what the market is doing and how well the properties are performing. And this is key. It means your total return isn't just the income they pay out, it's also the chance for your original investment to grow in value over time. So, let's wrap it all up. REITs and InvITs let you invest in massive real-world assets with just a small amount of money. They're super easy to buy and sell on the stock market, they're run by professionals, and they're a great way to diversify your investments beyond the usual stuff. And remember this, the single most important investment you can make is taking the time to learn. So by watching this and getting curious, you've already taken the best first step. Seriously.
So the door's open now. You have the key to owning a piece of the world all around you, whether that's an office tower, a busy mall, or a critical highway. The only question left is, what slice are you going to choose? And of course, just a quick reminder that this is all for educational purposes. It is not investment advice. You should always do your own research or chat with a financial advisor. Thanks so much for tuning in.